Hey, it's Soleil, and this is episode 21 of the Red Pilled Orange Pill Investor. And today I want to talk about why I think that selling covered calls is preferable to just straight up buy and hold, and also to like the dollar cost average strategies. And when I say preferable, I don't necessarily mean that it will result in the greatest gains. And if that sounds dumb, because why wouldn't you want the greatest gains? Of course you would, but you don't know the future. So the only thing we know about Tesla today is this little piece of data. So 213 to 214. Okay, that's it. You know, jack shit about what's going to happen for the next 10 years. We can look at the 5-year chart and we can see what did happen. And so let's just talk about buy and hold. If you bought $20 worth of Tesla here and you held for 5 years, it would go down to, you'd lose 25% of your value maybe. And then, holy crap, you'd triple your money. And instead of taking profits, you're just going to hold. And let's just say you bought 100 shares of it. So you got, what, you spent 100 shares at $20. So you spent $2,000 and you tripled your money and you got $6,000. Then you watch it crash all the way back down to 28 and you lose almost everything that you gained. Now, granted, the buy and hold people, you don't know that this is the top and you don't know that the new bottom is 28. But you're just going to hold and hold and hold. So you have to watch it go up, you watch it go down. Then you watch it here and you got to watch it go, from 20, that was like 7 extra money. Then trade sideways for a while. And then holy crap. Now you're 30, was it 15 extra money-ish? And then trade sideways and you're like, oh, maybe it's going to go to the moon or whatever. And then you watch and you lose half. This goes from 300 down to 200. So then you watch 33% of your value tank. Now you're still happy as a clam because you bought at 20, so this is like a 10x for you. But you watch it go sideways again, and then you see it at 400, and so you, 20 extra money? But apparently that's still not good enough because now you're just going to hold, because that's the buy and hold strategy, and you're going to watch your account go down by 75% because this tanked at like $100 a share. I don't know if I can exactly get the bottom. It was around $100 a share. So you're going to lose, you had 100 shares, and that equaled 400,000? No, 40,000, sorry. I went a little crazy there. But you started with $2,000 and you 20 extra money. Yeah, to 40,000. And then you watched your value go down to $10,000. And then you get some of it back, and then it climbs back to almost 300, and now you've got to watch it slowly kind of trade sideways, but somewhat down. Like this is a nice little downtrend here. Now, I'm a believer in Tesla. It's one of the only 2 assets I own, so I'm assuming this will go up to 400 and then set all new all-time highs, et cetera, et cetera. But there was at some point in here that I think Tesla was even at risk of going bankrupt. It might even have been before here. But this just traded. I mean, hell, if you got in here at $1 or 10 or whatever, and it just trades sideways from 2013 to 2019. Holy shit. I mean, you're a genius to get in here if it went to 400, but you're going to watch this trade sideways for 6 years on a buy and hold. That's wild to me. And you're still just going to have the same 100 shares. So you're just a slave to the price. Is where I'm going with this. And I guess for people that don't want to be in their account all the time and looking, for people who can just buy and forget, that I guess that works out. But I can't watch a stock trade sideways for 6 years. So what I would do is, even if I bought at this top right here, if I bought 100 shares here and spent $6,000, I'm selling covered calls against it, and I'm collecting 1% a week. So this would have been February 2020 all the way to this bottom here. So March 27, 2020. So about a month. So let's just say 4 expiration dates. And I'm getting 1% a week. At least now I have 104 shares when it bottoms out at 28. Now, granted, depending on how fast it goes up, like right here, well, let me just go back. This will be a little bit easier. So this is November 9th. If we go a week later, November 16th, let's see, what did it go from 209 to 233? If we only gave like a couple of percent upside on that call-away value, I might have chosen the 213 or 214, 215-ish strike. So I would have lost all of the upside from 213 to 230. Oh, actually 242. No, I'm sorry, it would have went down to 233. So maybe $20 of upside. But at the same time, when 100 shares is at 260, and a week later, was it 727? So, like right here, the price drops 5%. Is it 10%? And you're not buying new shares because you didn't sell covered calls. And then January 11th, same thing, it's down again. And then January 18th, it's down again. When this happens, I'm selling a covered call, collecting approximately 1% premium, purchasing an extra share. And so the same person that would have 100 shares of Tesla basically forever, and the value of your account is just the value of the stock price. But I will be accumulating shares all the time. Now, granted, where's this money going to come from when I have to pay $20 times 100 shares, $2,000? Well, hopefully, I've been accumulating enough shares along the way, and as long as, let's see, as long as I've had 110 shares, I can just, if I don't have the money to transfer into the account, I can just sell those 10 shares, get the $2,000, and cover that loss. And if your first thought is, well, then that just kind of defeats the point. Now I'm back down to 100 shares. That's true. However, you're selling those 100 shares at a profit. You're selling them because the price went up. So it's kind of forcing you to sell high. I think there's some, I don't remember the exact numbers, but the vast majority of traders just lose money. They just can't do it. They cannot make money in the stock market. And it boggles the mind because there's only one rule, which is buy low, sell high. So as long as you don't panic and sell low, you're going to make money in the stock market. And selling covered calls forces you to do exactly that. There's no other way to do it. Because the only time that you would ever be forced to sell your shares is if the price goes up. If the price goes up above your strike, let's take a look. So I sold the 217.50 strike. Sorry, the 227.50. So the only way that I would be forced to sell these shares is if the price goes up above 227.50. The only way that I would be forced to sell these shares is higher than what they are now. So picking a strike above the underlying share price, to me, is just kind of like it's just a framework for making sure that you never sell low. And every time the price stays under this amount, you have just gained extra premium to buy low. So the price stays below your strike, you get to continue to buy low. And every time the price goes over your strike and you're forced to sell, you're being forced to sell high. So this just, to me, this just seems like a solution for anyone who kind of just isn't cut out for the market. If you're the type of person that would, oh sorry, this is the call, that would look at Tesla and when it was blowing up from 250 and just rocketed up to 300, and you're like, oh my God, I gotta buy this before it goes to 1,000, and I'm gonna be rich and double my money, and it crashes. You know, if you're the type of person to buy in here at 300 or 400, and then panic when it hits 100, and now you've lost 75% of your money, if that's the type of trader you are, then selling covered calls, to me, forces you, let's just say, to not be a little bitch, because when the price is going down, you're still just selling covered calls and you're collecting more shares. So there's a little bit of a wind at your back, and you're able to buy the dips. I mean, granted, it's just one share a week. But that's how I look at it. So that's why I say that this is preferable. It's not necessarily, because here you might not gain all of this upside when Tesla doubles in the span of, November, December, January, 2-3 months. You may not catch all of that upside, but when you've accumulated a share a week for 6 years, as this trades sideways, 6 years is what, 300 weeks? So the person who buy and held with 100 shares for 6 years while this traded sideways, versus the person who sold a covered call and bought an extra share a week with the proceeds, has 400 shares. And when this goes up times 20, theirs goes up 20 at 400 shares instead of 20 at 100 shares. So that's buy and hold. But then dollar cost averaging, let's just look at a year. It's kind of the same for me. You're going to buy here, that's great. You bought at 140. Now you're going to buy at 200. So you're going to buy the top. And every week, maybe you're going to keep buying the top, Then you're going to buy a dip, and then you're going to buy the top. That's not buy low, sell high. That's buy whatever. Buy whatever you're given. And I know that they say that people who just dollar cost average into things or buy and hold or whatever, they end up doing better than people that are trading in and out. But that's kind of what I was saying before, where people will freak out and just panic sell. That's the only way that you can lose money, is if you You sell for less than your purchase price. What did okay, so my average cost for Tesla was 228. And I bought it like last year around 228. I suffered the whole crash to 100 and something. And actually, I was forced to sell some at around 120, 110, can't remember. And I did that because I misallocated my margin. And if it fell to 80, I wanted to make sure that I didn't get liquidated. So you can call that a panic seller if you want, but it was it was risk mitigation for me, and I'm fine with it. It's not like I sold my entire position. It was just, it was just enough to make sure that I was safe if there was another drop from 100 to 80. So yeah, I mean, dollar cost averaging. You're telling me that you're supposed to go in and buy at 407. If that's payday, you're supposed to buy at 407 just because we're dollar cost averaging. I want to have a covered call in at 380 or 400 or whatever, and at least if I'm buying shares at 400, it's because I got the premium from the shares that I already owned. I didn't take extra money out of my pocket. And really, you can dollar cost average. If you got more money to put into the stock market every week, then fuck it, dollar cost average, but then continue to sell covered calls on increments of 100 shares. It's not financial advice. This is just for entertainment, but this is what I do, and this is why I do it. So we'll leave it there. Be good, y'all.